Hey there! Did you know Baker's always gives you savings and rewards on top of our lower than low prices? And when you download the Baker's app, you'll enjoy over $500 in savings every week with digital coupons. And don't forget fuel points to help you save up to $1 per gallon at the pump. Want to save even more? With a Boost membership, you'll get double fuel points and free delivery. So shop and save big at Baker's today. Baker's, fresh for everyone. Savings may vary by state. Restrictions apply. See site for details.
The world of finance is a dynamic landscape where investors constantly seek innovative strategies to maximize returns. Short selling, a practice rooted in centuries of financial history, stands out as a unique and complex approach to profit from falling markets. In this episode, we'll delve into the multifaceted world of short selling, not only unraveling the traditional method, but also exploring a myriad of derivative instruments that offer alternative pathways for investors to engage in this speculative endeavor. Before we delve into intricacies of derivative strategies, let's revisit the fundamental principles of short selling. So it all starts with borrowing shares. At its core, short selling begins with the investors borrowing shares from a broker or another investor, anticipating a subsequent decline in the value of the security. After that, the borrowed shares are sold on the open market, and the proceeds are held in a margin account. And the third step is buying back. Investors patiently await the opportune moment when the price of the borrowed shares fall. At this point, they buy back the same number of shares at a lower price. And the final step, returning shares. It involves returning the borrowed shares to the lender, completing the short selling process. So, what derivative instruments can be used for short selling? First of all, options. Options provide a versatile avenue for short selling. By purchasing put options, investors gain the right to sell an asset at a specified price within a predetermined time frame. If the underlying asset's price falls below the strike price, profits can be realized. There are also futures contracts that offer a direct and standardized method for short selling. Investors sell a futures contract committing to sell the underlying asset at a predetermined price on a specified future date. The potential for profit arises if asset's price declines, allowing the investor to buy back the contract at a lower price. There are also inverse exchange traded funds, ETFs. Inverse ETFs are designed to move inversely to their underlying index or asset. Purchasing shares of these ETFs allows investors to profit from a decline in the value of the underlying assets. And finally, short selling CFDs, or contracts for difference. Contracts for difference, a more flexible derivative, enable investors to speculate on price movements without owning the underlying asset. Short selling CFDs involves entering into an agreement to exchange the difference in the asset's value between the opening and closing of the contract. While the investors have an opportunity to short sell, they also have an opportunity to implement various strategies around that. So let's delve in some of the advanced short selling strategies, such as margin trading, Margin trading amplifies short positions by allowing investors to borrow additional funds, increasing the size of their trades. However, this leverage also heightens the risk and potential for significant losses. Pair trading. Pair trading involves simultaneously taking a long position in one asset and short position in another. This strategy aims to profit from the relative performance between the two assets, mitigating overall market risk. So we can call this type of trading strategy market neutral. Short squeeze opportunities. Monitoring stocks with high short interest can unveil opportunities for short squeezes. A short squeeze occurs when a heavily shorted stock experiences a rapid price increase, forcing short sellers to cover their positions and exacerbating the upward momentum. While short selling can be a very appealing strategy for some traders, and it plays a crucial role in market efficiency, it's not without controversy. So, there are market manipulation concerns that involve short selling. Critics argue that short selling can be used to manipulate stock prices, potentially harming companies and their stakeholders. There is also an excessive amount of risk involved. Short selling involves unlimited risk, as there is no cap on how high a stock's price can rise. This exposes short sellers to significant potential losses. There is also an ethical dilemma. Profiting from the decline of the company raises ethical questions about the impact on employees, stakeholders, and the broader economy. Short selling, whether through traditional methods or derivative instruments, remains a nuanced and controversial strategy within the financial world. While derivatives offer alternative avenues for short selling, investors must approach these strategies with caution due to their complexity and the potential for amplified risk. As markets evolve, the ethical considerations surrounding short selling will continue to spark debates, emphasizing the need for a delicate balance between market efficiency and ethical responsibility. In navigating the intricacies of short selling, investors must remain vigilant, adaptive, and conscious of the broader implications of their speculative action.